Hi, I'm Brent Stafford, and this is Reg Watch by regulatorwatch.com. Canadian investors, they face many unknowns. One way to gain a little control is to invest at home. Buy Canadian stock listed on a Canadian exchange. But it's not always so black and white. You may think you're buying BlackBerry on the Toronto Stock Exchange when in fact your order may be diverted to the United States for execution on what's called an off-exchange intermediary, exposing you to predatory high-speed trading. Canadian regulators acknowledge a number of investment dealers are routing Canadian retail investor orders on a wholesale basis to U.S. dealers for execution. Typically, when Canadian orders are sent to the U.S., they are not executed on transparent U.S. exchanges like the NASDAQ or New York Stock Exchange, but instead on private, dark pools operated by notorious high-speed trading companies such as KCG, Citadel, and ATD. So are the firms managing your investments routing Canadian orders for Canadian stocks out of the country? Well, the answer is a bit hard to pin down. According to a November 2014 report in the Wall Street Journal, Canadian regulators say the brokerage arms of many of Canada's biggest banks are making moves, and the practice could threaten the effectiveness of Canada's stock markets. While most of the big banks declined comment, TD did tell the Journal it does not engage in the practice, and RBC says it's not routine. So why would Canadian investment dealers send order flow down to the U.S.? Well, for profit, of course, and not always for the investor. According to the CSA, Canadian investment dealers may receive payment or other benefits for sending orders to U.S. dealers. If it's true, it's a stunning conflict of interest and should prompt many Canadian investors to have a heart-to-heart with their investment dealer. There are short and long-term impacts to the practice. Wholesaling orders to the U.S. may deliver investors a better execution, meaning speed and price, but they could also end up paying more than they would have if purchased in Canada. Long-term, the practice could drain liquidity from the Canadian market, impacting price discovery and slowly eroding the viability of Canada's capital markets. Over the past 12 months, IROC, the National Financial Markets Regulator, has jumped to address the problem, issuing guidance to adjust the exceptions that allow orders to be executed on foreign organized regulated markets, such as the NASDAQ and New York Stock Exchange. It has also tightened restrictions on order flow directed to U.S. intermediaries, which substantially lack the same monitoring and reporting rules as Canadian exchanges. But it's complicated. IROC can only go so far. Canadian investors do deserve access to the best price, and barriers to trade securities cross-border are extremely low. So are regulators doing enough? How big is the problem, and are Canadian capital markets in jeopardy? RegulatorWatch.com put these questions to executives from Canada's leading stock exchanges to find out. Kevin, you're the VP of Business Development and Strategy for the TMX Group, the owner of Canada's main stock exchanges, including the Toronto Stock Exchange. Please tell our viewers, are Canadian dealers still routing orders to the U.S.?
Yes, they are, and there's a variety of different reasons for that routing to take place. We started to see dealers in Canada be attracted by arrangements that are quite pervasive in the U.S., and they have a different market structure and model where you have these wholesalers or these intermediaries that purchase or take in retail flow, and they provide very good economics, cheap execution. They provide a lot of liquidity, immediacy of execution. There's a strong value proposition there.
So is this a big issue for Canada's capital markets?
Yeah, I think it is a big issue. I would agree with that. And I just want to be clear that the issue is more ensuring that Canada is a competitive marketplace. That's what it comes down to. And if Canada is not a competitive marketplace in the global context and certainly in the North American context, then that is a big problem.
So Kevin, if it's a problem, do you think regulators have done enough to address it?
Yeah, you know what? Surprisingly, I think I might say that in general, we think they have appropriately kind of responded to this. You know, they're trying to strike the appropriate balances between the practicalities of, you know, operationally managing, you know, client flows cross-border for a variety of different purposes, you know, balancing the interest in trying to put a framework in place to make sure Canada is competitive.
Kevin, you haven't just left this for the regulators to handle, correct? The TMX Group has brought in a new model for its alpha trading platform.
The alpha model, the intention of the alpha model is to provide an environment where natural order flow, retail, institutional order flow can get cheaper execution, reduce costs, and improve quality of execution.
And Kevin, tell us, why should the regular Canadian investor care about this issue?
We need a strong capital markets in Canada, both to attract issuers, to attract investment and capital into our economy, into our markets. I think we all have an inherent kind of responsibility to support and continue to make relevant the Canadian capital market.
Joss, you're the CEO of Equitas Neo, Canada's newest stock exchange, pegged as the kinder, gentler alternative to the TSX. Tell us, are some dealers still routing order flows down to the U.S.?
I'm sure that some parties are doing that and maybe have done it more and are maybe doing it less now. I don't know, but I'm sure some parties are doing that, yeah.
Well, how much of a threat to the Canadian marketplace is that, Joss, if those deals are being sent down to the U.S.?
Well, I think much less than what a lot of people think, based on the studies studied on before by IROC. If you look at that and you look at how they decomposed the flow and what flow we're talking about, because we're talking about mainly interlisted securities, it has to be retail and it has to be what we call in our jargon active orders, i.e. when you take liquidity, because that is really what we talk about. It probably represents 3% or so of the overall volume in the Canadian market.
So then, is the problem not big enough to warrant new regulations? I
personally and our organization, was against any regulation to prevent that. I think what we need to do here is, be competitive and provide quality execution in Canada, and that is the right answer.
Joss, we've heard from the TMX Group that the diversion of order flow to the U.S. is a problem. How does what you are telling us square with that?
I think it has been used a bit as an alibi to justify a market model which is maybe beneficial to the TMX, but I don't think is beneficial to the market overall and to the investors overall.
Kevin, we've just heard from Equitas Neo, and they told us that the TMX Group essentially has been promoting U.S. order flow as a problem in order to justify the new alpha model. What do you say to that?
That is completely false. I would disagree with that wholeheartedly. We have IROC recognizing through, policy decisions and proposals out there that this is something that needs to be addressed or acknowledged. Just look at the success after, 8 weeks of alpha, the new alpha model being in existence and having 5.5% market share. We have a lot of retail support, and we have the fact that these type of arrangements, selling or sending order flow to intermediaries south of the border, we believe that those are no longer being actively pursued anymore.
If you want to ensure your stock orders are executed in Canada and not in the U.S., tell your broker. They have a best execution obligation to follow your instructions. Well, that's it for this edition of Reg Watch. Before you head off, please like us on Facebook and don't forget to follow us on Twitter. For regulatorwatch.com, I'm Brent Stafford.